And a very good morning to you, and welcome to the Friday, April 8th, 2022 Trigger Charts pre-market rundown. Thanks for being here with me today. Lots going on. Things to tell you about that are really important, not only in the markets, but a few important updates. So make sure, I'm going to tell you right at the beginning, you pay attention because there's some important items up. Hey, I'm Andrew Horowitz. I'm the co-founder of TriggerCharts, and we are going to talk about the indicators that we have available, of course, as well as the market profiles and market itself, as well as what is shaping up to be. Once again today, a little bit of a red opening on the start of the day. It seemed that things were doing pretty well overnight, but then again, we see what happens as rates go up. To the right, you're looking at a chart of the rates. We'll get to that in 1 second. Before we do so, I have to mention that investing involves substantial risk. Past performance is not a guarantee of future performance or results or anything of the kind. Nothing we say here is a guarantee or even a recommendation, so make sure to adhere to that principle, and please consider everything that we talk about for educational uses only. I think that's a really important point to put out there. With that in mind, let's close that. Good group of people here. All the recordings of these sessions are available either on our YouTube channel or over on TriggerCharts. There are overview tutorials and information instructions over on TriggerCharts. There's a link I just put in the chat. Of course, I want to hear about your stocks and your particular symbols as well, and things that you're interested in. Now, before we go anywhere, I want to mention something. I think it's really important, and I'm going to tell you something that you need to hear, because there is an important announcement regarding the TradeStation Trading App Store. There's going to be an update happening with the Trading App Store. And as that goes, right now, what they did was the Trading App Store is no longer accepting new subscriptions. If you have one, you're fine, but no new subscriptions to the Trading App Store. What that means to you is that do not uninstall or cancel your subscription for the foreseeable future. And why I say that is, if you do, you'll never be able to get it back under the current program until they update the trading store, the Trading App Store. So just to kind of really hit that point home, if you are a subscriber, you will be fine. If you unsubscribe for some reason until they get a full update, and I'm not sure when that's going to be, well, I know it's going to happen, but I'm not sure it's going to be a week, a month. But point is, you'll be locked out. So do not unsubscribe under any circumstances, because right now, until they go through their transition with the Trading App Store, you're going to be locked out. If you are on a trial, you're probably not going to be able to subscribe right now, which is a problem. But we're moving along with that. I will have more information as it comes over the next couple of weeks. There'll be a lot more information on some exciting things that are happening with them. This is all good. It's all really, really good. But again, I'm just going to state this for the point so everybody hears me very clearly. As a subscriber to the TriggerCharts Trading App Store, the TriggerCharts and the TradeStation Trading App Store, do not unsubscribe to your platform with us, because or for that matter, anybody, because you will not be able to resubscribe again until they get this whole thing worked out. And now, I don't know if this is going to take a week, a day, a month, 2 months. Point is, you don't want to be without it. So just keep that in mind, okay? We'll keep you updated on all that. Let's talk about the markets where we are right now. Interesting what's happening. To the right, there's a chart, a very important chart to the right, because that chart to the right is telling a story really of what's going on. And since, well, we'll say this movement here throughout the end part of 2021 into 2022, and then again, a bit of a consolidation. Then we're talking about a full-on ramp. What is that? That's rates. That is the 10-year Treasury rate. Now you see 227.11 right here, right? That really means 2.711. We're topping out. We're kicking up again, higher than even yesterday, on the prospect that the Fed is going to back off on their bond buying, which we know they are. They're going to start thinking about, with the inflation situation as it is, because the market is telling them to do so, raising rates and maybe even going a total of 50 basis points. That's something they've been talking about now at the next meeting, which I believe is in May. Now, on top of that, look at this thing moving. It's 2.715 now. That will probably have a direct reflection on your NASDAQ as it's moving. The Dow may not be as much because you got some banks and other things in there that could do well. Your S&P's right in the middle, but your NASDAQ here is really going to get bludgeoned as we see this moving up. And we'll keep an eye on this throughout the day. 2.715 is the number right now. That's a big problem. That's what's giving us this whipsaw, this daily movement, because throughout the day you see the bonds moving all up and down, up and down. Obviously they've been climbing, but every time we see, well, maybe it's not okay. Well, maybe it's not okay. So what's happening is it's really throwing an incredible amount of concern to the markets. Now, of course, you have to think about what else is going on, right? On a daily basis, what's happening that's making it so difficult to have direction. And where's the direction right now? I would say we're in a consolidation right now in terms of markets, that is. We're around the 50-day moving average. Yesterday, we popped down. We got the 200s in play. We bounced right off. Bounced off support on our indicators, which I'll show you in a second on the Qs, on the SPY. IWM is a little bit in nowhereville, I guess I would say. That's a small caps. But generally speaking, we're seeing a really good amount of support and resistance that is being adhered to when it comes to the TriggerCharts Commander Series with the autopilot and the altimeter. Those are working beautifully if you just obey. Like right now, for example, if you were on a daily basis playing the idea that, hey, you know what, I will track what the TriggerCharts altimeter and the autopilot says, you would have been long rates, short bonds, right here, 2.1. We're 2.7. It's green. It's green, which means long. Long means that we want to be long rates, short bonds right now, or at least not overly invested in bonds. This happens to be one of the worst start of the years for bonds in history. Matter of fact, I think it's the worst bond route. If you just stop right now at this exact moment and you were to say, this is the end of the year. Hey, we're done. The year is over. This is the worst year for bonds in decades and decades, 40 years as I've seen it, if not more. Now, of course, we don't have the benefit of if, in fact, we have returns that are total return. We're talking about just simple price action right now. And when you have price action, we're not putting in the yield. So if we have a 2%, 3% yield, you have to push that in by the end of the year if, in fact, bond prices don't move from this point right now. What we're seeing is a little bit of panic that is going on because the Fed is not buying bonds. They're not the ones going after and trying to cool the markets. In fact, they're trying to do quite the opposite, and we know about that. On top of that, we have inflation. We have headlines. And this headline issue, just watch this. It just keeps out. Just watch. Keep your eye on that as we talk. 2.719 right now. So we cracked the 2.7, and now everybody's thinking, hey, we cracked that 2.5 number. Are we going to 3? That's the question anybody wants to know right now. But we have too many headlines on a daily basis. We got the war that's going on. Are we going to stop supporting, or are we going to continue supporting? Are we going to see that there's going to be another sanction put on like we saw last night with coal imports that will slowly be resolved over the next 2 or 3 months? Maybe Europe is going to do something like stop all oil imports, which will be shooting themselves in the foot, or actually right in the chest, I guess. Then we see what's happening with the Fed. Every day they're out. We saw Brainerd this week coming out with some very harsh words, very hawkish. We see, of course, this week, the Fed minutes come out. We see the Powell's making the rounds. We see that each and every, like Bullard, who has become an extraordinary hawk right now, meaning that, hey, let's just keep on raising interest rates right into the face of a financial calamity. And they are trying to show us right now they don't care about what happens to the markets. They got enough lift over the last year and a half to say, you know what? If we take a 20% drop, which we're halfway there on some markets already, not the worst thing in the world. Let's flush out some of the excess, take out some of the wealth impact of what's happening. There are areas to be in. If you think that they're trying to do so, what about the value side of the equation? Looking at oil, energy, looking at things like commodities due to inflation that will be tamped down, but still the benefits of the higher prices of oil are really going to and have been helping many companies inside the energy sector and the peripherals. You look at utilities, you look at to a point maybe certain interest sensitive, but yet not rate sensitive, which is a bit of a differential. You look at those areas, those are things you want to look at in this market as well as the inside of where we're trading. But right now, the headline bombs are really probably giving you a lot of problems. I'm throwing this out there to you, saying that the probability is that we need to start thinking as traders that either we're going to be very short-term minded or very long-term minded. In the middle of all that is trouble. And I hope that makes sense. There's different kinds of trading that you want to do at different statuses of an economic and a market cycle. Right now, I mean, I don't know about you, but this is just unbelievable. We're just seeing this continue to move up, 2.721. We start out right about here when we started talking a few minutes ago. So this is moving up very, very quickly. The dollar is also moving up quickly. A lot of this is a self-fulfilling prophecy. I would think that we're starting to get very long in the tooth with this rate issue. And it would seem that while the rates are probably subject to moving higher, it's higher than the Fed is willing to go in the immediate future, and the markets are adjusting a little bit too aggressively. That is my impression of what's happening. This is, if you saw a stock do what's happening here, this kind of parabolic move, you would say, wait, that's getting a little toppy here. So where it tops out, of course, if things move much further beyond where you expect it to move, I still believe there's a lot of opportunity in a variety of other areas. And one of the things you may want to start looking at, even though right now we have a very wonky yield curve, and I think Kevin Hoffman spoke about this last week, the wonky yield curve that we're seeing right now. But banks are going to be starting to show up with their earnings next week. And that could be very interesting because we do have a benefit of a steepening yield curve to a degree and almost an inverted right now. So it's good and it's bad. Depends on what kind of financial institution you are, and are you doing more, for example, Goldman Sachs, trading and doing mergers, acquisitions, and doing deals. Is that good for you? Well, or JP Morgan, or Bank of America, right? Or Wells Fargo for that matter. So, but all sorts of sides of the equation of what you do in finance. If you're stuck in the area of doing primarily, let's say, trading and deals and bond refinance, who's refinancing their bonds right now? Who's refinancing their mortgages? If you're in the market that deals with primarily the retail, let's talk about like a Wells Fargo, what do you have to offer there? Well, maybe you have concern about the fact that the yield curve is a little weird and the mortgages that you're going to put out there to the retail is not going to be great and a refinancing rate's going to slow, but you have the idea that, you still don't have to give a lot on deposits at this point, so you still have a beneficial net interest margin to a degree. And if you have somewhere in the middle of all that, you look at mergers and acquisition and deal flow and trading, trading will probably pick up because the volatility that you see in the markets, that's a natural phenomena that happens. So we have to realize that that is something of interest. So somewhere between the Wells Fargo and the Goldman Sachs could be the sweet spot when it comes to financials. And when and if that yield curve starts to come back to a more normalized level, that could be very beneficial for those inside players. So you think about maybe like a Bank of America. Let's see where they are. Let's see what they're doing. Now, let's take a look. Let's just take a second here, just for the fun of it. And let's look at a Wells Fargo. Let's look at a daily chart to the right here. Coming from $60 down to a support level of 46 and change, up a little bit today. Like I said, in the face of higher interest rates, you may see some resilience, but the concern about a recession is also in there for a Wells Fargo. Let's look at a Goldman Sachs, for example. Pretty ugly. Morgan Stanley. Pretty ugly, right? But let's look at a Bank of America, for example. Again, still pretty ugly, but looks much more like the Wells Fargo. Let's bring back Wells Fargo. Does that look almost exactly like the same chart? You look at a JP Morgan. JP Morgan is somewhere in between. So those companies that you have that are the companies like a Goldman Sachs reaching a low that they haven't seen in some time is because of the deal flow and what they do on the corporate level. Whereas a Wells Fargo, I'm not saying it's necessarily holding up better. It's still down good $14 from its top line, which is 20+% from where it was in, we'll call it the beginning of March, when everybody thought the yield curve was in good shape. But the fact of the matter is that it still is a bit better when you look at the Goldman Sachs, 420 now 308. That's 100 something. That's a 25% or 22%, something like that move. So keep your ideas open to where the potential opportunities lie within not only the markets, when we just look at the NASDAQ versus the Dow Jones or the S&P 500 or the small caps or whatever it is, international, for example, when we look at U.S., here's the SPY, for example, look at the right chart and look at EEM, for example. That didn't work. That worked there? EEM, big move down, but look at the recovery that we've seen. EEM may be flushing out dramatically. EEM was down over the last couple of days. That is tracking where we were with the Qs of the last few days. But again, very similar charts on a global basis right now, and all due to the concern about, are we going to have the Fed pushing us all into a recession? We talked about all the rage of what's happening with the Treasury yield above 2.5. That was yesterday, 2.6. We're at 2.7 and change now. So again, moving very quickly. You know, the interesting thing is people say, well, hey, wait a second, Horowitz, the economy remains strong. We're seeing that the employment situation looks pretty good. In fact, yesterday we were at a 60-year, or maybe even an all-time low, 166,000 new initial claims. Okay, interesting. And we're going to see probably, the continuation of a good unemployment number over time. And that is going to take some time, just like any of these deals that happen with the Fed. The blunt instrument they have of an interest rate and the quantitative easing takes a long time to funnel itself into the economy. That's why you're seeing manufacturing picking back up again. But the big issue that we all have to recognize, and I think we need to get off of this whole dilemma of prices, that right now we are in a supply shock situation. It's only one part of the equation. The other part of the equation is demand. Eco 101, supply, demand, right? When you have too much supply and not enough demand, you got a problem, prices come down. When you have too much demand and not enough supply, prices go up. Right now, is it demand? Yes, to a degree, but really it's all about supply. And if you think about what's going on around the world with chips, with even things like chicken and what's happening with chicken, with the avian flu, with what's happening in the China ports due to the lockdowns in Shanghai, closing those down and ships just sitting there waiting to get in. We have a very strange supply chain dynamic right now that is causing a lot of this that could break very quickly. Let's not even talk about what's going on with oil and commodities and wheat prices and food prices due to Ukraine and the war over there. So Fed is determined to break the expansion, but they're also having to look at what is the reasons for what's happening. Housing prices remain high, inventory is very low, and again, a lot of that is because of, yes, demand, no question about it, but as interest rates go up and we are seeing the 30-year mortgage tip over 5% right now, 5%, that's a big issue, and that is going to break the housing cycle to a degree. If nothing else, it may not stop demand, but it's going to lower prices. Think of it that way. Inflation, we talk about that. Ukraine, fuel and food is a big issue. So we did see a nice move down on oil. Let's take a look here. Not there. Let's look at CL where it is today. Up a little bit today, but look at this move down from where we were at 130. Clipping right down at support. Look at that holding support so well. Look at that, right at 96. Next stop, if we do continue to go down 88, I would think that that's not going to be the case, even though we're not only in the United States, but the IEA says there's another probably about 2 million barrels a day of strategic global oil reserves are being released, or at least they said they are being released into the wild, and that's a big issue right now. That's helping to calm the oil markets to a degree. Wonky action, clearly. Let's talk about the KRI. I talked about this. I focused on this. I tweeted on this. I said we never saw a +6 right here, a +6. We haven't seen that in ages. The last time we saw it was back over here. And look what happened. We saw that move lower, then a recovery, and then another move down till we got that all lovely -4 cluster. So the point is, psychologically, right now we're in a bit of a downtrend. If you look at the market as in equilibrium right now, we're right at the zero line right here, right? And we say, well, what is happening? Well, the overall market, as measured by the key reversal indicator, is currently not overheated or oversold. It's not by this indicator. You know, we can look at other ones. We can look at where we are here. This is the Spearman coming down, still not oversold on the McClellan. As a matter of fact, McClellan holding very nicely. I thought it was really interesting that we saw a complex model above the zero line from McClellan, which usually starts the next leg up. I was doubtful of that, but this was a pretty substantial rally here. Where do we go? If you just look where we are from all things and you just want to draw simple lines, that I would have drawn that back to this level here, and that's where we landed yesterday. That's where we're going to come to somewhere around today. This is on the S&P 500 index, the cash index. Finishing up here. Very much indecision in the markets right now. Important to be very, very nimble. Be careful not to trade on the open. Position size yourself. We see things like GameStop, which did a split, was up all sorts of numbers, came right back down. Okay, so there we go. We talked about TNX, obviously. Let's look at this right here. Above the line, nothing to talk about. Trend is positive on the aileron. Things are moving up, 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 up. 2.719, coming down a little bit this morning. We saw what happened with Twitter the other day where there was this consolidation for a long period of time. And clearly, nothing more than a simple announcement about Musk getting in the game. No real levels to look at here of importance. I mean, maybe it came back to where that consolidation level was right about there, why it stopped there. But Musk taking a 9.2 active position, even though he said it was a passive, taking an active position. For those of you that just came on board, I need to mention something to you. I want you to listen very clearly what I'm about to tell you. This is really important because a number of people have joined a little late. You have to pay attention to this. Right now, if you are a subscriber to the TriggerCharts indicators on the TradeStation Trading App Store platform, do not cancel because you will not be able to renew until they do an update. And that could take a little while, and you don't want to be without this. In other words, what's happening is they're going through a transition with the Trading Store app. They shut down all new subscriptions or not renewals. You can continue on, but any brand new subscriptions. But that means that if you cancel, you have to resubscribe, and that can't happen. Do not cancel until I tell you what is going on and how they're going to do it. I think there's some pretty cool things I talked about it that they're working on, but you'll be, I think, very pleasantly happy, but you have to maintain your subscription. I'm telling you right now. So if you go over to you'll know what I'm talking about. If you go over to the Trading App Store, you'll see that every single indicator in the Trading App Store is not available to subscribe to. None of them. So just pay attention to that. Talked about GameStop a second ago. Came right there to that level we talked about, which was very good overall resistance. Actually, we got almost to the $200 level in the overnight action when they announced that split. And as we know, splits don't do anything right there for anybody. Roblox, we've talked about this. Just a terrible disappointment. Sitting on support right now in the 43, 44 area. JetBlue merger potential. They didn't really like that, but oil prices are also hurting JetBlue travel, the potential for a recurrence of what is going on. Massive consolidation for a long period of time, now dropping down, to levels that we haven't seen, of course, back to mid-22, but also back to 21. Save is also going through this process of potentially being bought by JetBlue. We'll see what happens there. W, which is a Wayfair, what a miserable chart. You got all sorts of problems. You got cost factors. Fact is that people are not buying for their homes as they were when they were building their offices for the work-at-home situation, stay-at-home situation for COVID, although that might be changing a little bit. But lockdowns are no longer a thing, it seems, at least in most of the world. Take out Shanghai and China. So what we're seeing right now is Wayfair with price hikes, with port issues, with slowing sales, really in just ugly shape right there. Costs, we're not going to really talk about that. AMD, no. Okay, well, I have some other ones here. ARC, hitting on support right now, down about 1% today, down pretty hard yesterday. Many of these stocks are taking down the chin once again as interest rates go up. And right now, where are we? 2.717, backing off ever so slightly. DWAC, interesting. This is the Trump Twitter, quote unquote, that is seeing a lot of people in the higher ranks leave because it's just not doing it. I guess they can't get on. The Truth Social, not happening. People are pretty upset about it. And now that you have Elon, which is, I guess, it's an anagram for it, I guess. Elon, where Elon is now involved with Twitter, that is saying, well, maybe we'll all move over that way because it'll be more, quote unquote, free speech. This is an interesting chart, I thought, because one of the things you want to look at here, and this is something to really pay attention to here, is the consolidation, right? When you see these long consolidations, and what happens during consolidation, I want you to think about this. You get this coiling effect, coiling. And then what happens from there? It's either going to rip or rip, right? Think of this. Always look at this. Think of this in your mind, this coil. It's not really moving above it, but staying within a range, coiling. And then what happens after that is usually a very pronounced move. In this case, was higher. Now, in this circumstance, you could very easily see that it was very concerning that, there's all the EV talk, that, oh my gosh, Ford's going to catch up. How wonderful. It's going to be great. GM looks pretty much the same here. Let's pull that up. Well, not exactly the same, but everybody was excited about it because Ford came first, I guess. But GM is at, look at this. Look at the lows not seen since 2020. Why? They can't get car parts. Prices are up. Margins are squeezed. Not about not selling cars, because they're selling cars. Can't get them off the lot. I saw today a Porsche ad that was something like $130,000 for the Porsche and a price market adjustment for $150,000, making it a $280,000 car. I mean, come on. Bumble, here we go again. What do you see? Do you see what I see? Do you see it? Coil. Where's it going? Well, right now the trend looks like it's down for Bumble. And from there, it could really explode very dramatically. You may see some continuation of that coil, but be ready for this short side, which it's leaning on. See how it's leaning this way? It's leaning this way. You got this coil, leaning down. So just pay attention to that. Some people have asked about a few stocks. UEC, of course, uranium energy doing well as an alternative energy source. Same thing when you see like an XLE down a little bit today, but XLE, which is, of course, where's oil today? Oil's down a little bit now, moving lower throughout the morning here. This is the 5-minute chart moving lower. 96 on oil, seeing the market just generally just decay throughout the morning. But UEC looks great. I mean, could break up. It did break up. You got an alert right here from yesterday. Up again today. Where do we go from here? Looks like you're in great shape. Finally, people that are looking at uranium as an opportunity are getting the long awaited move. Now, if you were a holder for some time, and let's even go back and look at the weekly chart on this. I mean, a lot of people suffer for a long period of time, but you know what? You got a 5-bagger if you bought it somewhere in 2021. So pretty good on that. It's looking pretty healthy right now, especially with what we're seeing with the idea that we need alternative energy sources. AR, and then we got also, somebody says about IBM. Yeah, same thing. You're seeing just a beautiful move of many of these stocks that are in the, we'll call it energy type of services or energy field in its entirely. IBM. IBM, someone's asking about. Yeah, IBM, in between. It's a tweener. Don't see anything really happening there. We got an aileron that's moving up ever so slightly, but nothing great there. Listen, we're going to end it right there. Remember what I told you about do not cancel because you won't be able to subscribe. If you have any questions, send in your questions to support@TriggerCharts.com, and I'm going to see you again next week. Thanks for joining me.